Well, to talk us through that, Frank Donnelly joining us from MA Financial. Frank, good to catch up with you again.
Hi Andrew, how are you?
Very well. All right, so it's quite amazing what's been going on in the UK, of course. You're going to take a look at those UK pension funds and the effect that that's had here of pulling the money out essentially. What's going on?
Yeah, it's interesting, Andrew. I mean, the excitement, let's say, in credit markets continues. And what's been happening here is that global investors, but particularly UK pension funds, have been selling very large amounts of bonds that are called mortgage-backed and asset-backed securities. So these are bonds backed by large pools of loans, home loans, car loans, and so on. And the UK pension funds have been selling these in very large numbers. There's been about $1 billion traded in the last few weeks as investors have looked really to dump those assets. So it's been a little bit of a fire sale in those assets. And when you do see that, you always need to ask the question, why is the seller selling? Are they selling for fundamental reasons because they don't want to be holding a ticking time bomb when the music stops? Or are there non-fundamental reasons at play peculiar to those institutions, and does that then present opportunities?
No, go on. Yep.
And obviously, I think that in this particular case, what's actually happening is that there's not a crisis in the Australian mortgage market, and certainly not the Australian securitisation market. I think what's actually happening is that there's a crisis in the UK pension sector. These pension funds had been doing something called liability-driven investments, which is basically using derivatives to help them meet their future obligations to retirees. And with the currency and bond market revolts over in the UK, currency trading off, bond yields in the UK spiking, there were significant margin calls on these derivatives, and those UK pension funds had to look for other assets to sell. And when you do need to sell, what you tend to do is sell your highest quality assets. You sell high quality assets that you know there'll be demand for.
Yep.
And that's happening in Australia, but it's also been happening with things like US high-grade corporate loans over in the States as well.
Okay, so you don't have any particular concerns about the mortgage market here then, given the funds that have been pulled out, but also is it reassuring perhaps that what we've just heard out of the UK, with they've completely done that U-turn. What effect is it going to have? What are those UK pension funds likely to do now, do you think?
Look, I think it's fair to say that the market is still concerned about the impact of liability-driven investment that is distinct from what's been happening with the UK tax regime and tax policy that was announced. The tax policy was a bit of a canary in the coal mine that highlighted the issue that existed with these kind of derivatives, and now that needs to be unwound. So you might very well see more of this kind of selling, and that would be an opportunity. Look, we've been opportunistically participating in some of these auctions and buying what we think are very high quality assets at very attractive prices. So there's opportunity there. To your specific question about the Australian mortgage market, look, performance of Australian mortgage pools continues to be very good and very resilient. Arrears, I think, are at about 64 basis points according to Standard & Poor's, and for non-bank prime, I think it's currently about 29 basis points, which is a record low, really, and certainly a low post GFC. I think what you've seen in that market across the board is that lending standards over time have continued to improve, and what's been happening is that there's been more competition in the banking sector, but the competition has been leveraging some structural elements of the market, more access to funding for competitors to the major banks, rather than people taking share through a weakening of lending standards. So I think there's some comfort to be taken there. That said, the Australian borrower is very levered, and there is a tail there. There's a tail of borrowers that I am watching carefully, and I think that it's worth being a little bit concerned about, and you do need to make sure that wherever you're investing money that's related to the Australian mortgage market, that you're not exposed to that tail, but you're focused on the bulk of the market where the quality is.
Yeah, because obviously with interest rates still rising, there are a rising number, I guess, of borrowers who could be left exposed with problems of serviceability.
Yeah, and look, there's a lot of borrowers who took advantage of very low fixed rates in the last few years. And through calendar 2023, those fixed rates will reset, and the figures are just enormous. It's over 90 billion for CBA, it's over 80 billion for Westpac, and those customers are going to see significant increases in their cost of cost of their mortgage financing. But what it will probably mean is that those borrowers will look elsewhere. So I actually expect a large amount of refinancing activity to take place on the back of that. The question will be, are there some mortgage prisoners out there, if you will? Are there people who stretched themselves when interest costs were very low, and now there's been such a dramatic change in such a short period of time with the outlook for interest rates that there'll be a pocket of people who are going to get caught and they're stuck in a loan they can't afford, and they can't refinance to a better deal because they can't actually service at the new level of evaluation of credit, which is a function of higher interest rates. And there could be some of that out there, but so far it looks like that's actually quite a small portion of the market. And there was actually some good analysis by the RBA recently in their financial stability review, which sort of showed that for most people, even if they get in that scenario, they have a significant ability to contract their discretionary spending that will mean they can build up payment buffers on their mortgages. So you're more likely to see, I think, a significant contraction in discretionary spending rather than an immediate impact on mortgage pools.
So just back to where we began then, just as far as those UK pension funds, obviously having to pull that cash out, what does that do to funding costs along the line?
Yeah, well, there's no avoiding it. It causes credit spreads to rise, which means that it causes the cost of funding for lenders to go up. And in capital markets, in lending markets, sometimes you're the windshield and sometimes you're the fly. And at the moment, cost of funding for some types of lenders is going up faster than they can pass that on to borrowers. That's good in a way if you're sort of an investor in credit, because you can actually participate and extract better value than you have been able to before, because the supply-demand equation's on your side. If you are whether a bank lender relying on securitization or public market funding, or a non-bank lender, that could put a little bit of pressure on you for a period of time. But the highest quality lenders, the best banks and non-banks, will be able to get through this, I think. Even during the period recently when the UK pension funds were dumping these assets, Pepper, for example, was able to launch and price a $750 million residential mortgage-backed security deal. So if you are backing a high-quality issuer or investing in a high-quality non-bank, then I actually think they will have the staying power to get through this for a period of time, even if it does get a little bit rocky around their funding costs and see a bit of margin compression.